PayPal, ticker PYPL, is an American multinational financial technology company operating an online payment system in the majority of countries that support online money transfers. Through the last 5 years, PayPal has gone through a large stock price boom as most everyday activities were moved online due to quarantine. From 2018 to 2020, the stock grew by more than 50%, from $77 to $120. The price then started steeply rising and reached a peak of $308 per share before it quickly fell to $74 in mid-2022. Since then, the stock maintained its price below $100, which, if you are observing, is currently more than 40% lower than what the cost has been before the large bump caused by COVID. Therefore, today I want to evaluate PayPal and see if the stock might currently be trading below its intrinsic value, and if now might be the best time to buy a few shares. To do this, we'll quickly jump to my spreadsheets model where we will evaluate PayPal using the 8 pillars. We will then find the value of the stock by applying a variety of valuation methods such as the grams valuation, the discount cash flow valuation, and the multiples valuation. Along the way, we will also view the analysts' predictions for PayPal for the next few years. Before we start, all the research tools I use for my stock analysis are free, such as Yahoo Finance or Macro Trends. So if you want to conduct your own research, the links will be in the description. Now let's jump to our main board. Here are my indicators, green for an increase year over year and red for decrease year over year. To the left, we can see the income statement showing the total revenue has indeed been increasing, and by the end of 2022 stood at 27.5 billion. Gross profit and net income are also increasing. Here we can see the cash flow statement with an increasing year-over-year free cash flow at about 5.1 billion for the year 2022. Finally, we have the balance sheet, which I will go into more depth in a moment. Further down, we can see the analyst's current target price of $102 per share in the next year, which is, in my opinion, certainly an achievable price for PayPal. But let's move to our 8-pillar analysis, which will allow us to analyze PYPL based on its metrics. First, we want the average 5-year PE ratio to be below 22.5. And as the current PE ratio is about $31, the price to earnings is a little bit too high for our liking. Therefore, I'll give this metric an X. We also like to see a profit margin of a company to be above 10%. PYPL is currently sitting at about 14%, which is very decent actually. Next, we want to see growth in revenue and net income over the last 5 years. This metric, although very simple, is probably one of the most important metrics I look at when evaluating a stock. It shows whether a company is growing. And of course, as an investor, we like to see our companies growing. Both have been increasing steadily by an average of about 14%, so that's a tick as well. I also like to see the decrease in the shares outstanding. If you own shares in a company and the company sells out more shares to other investors, the percentage of the company owned will gradually decrease. This goes the other way around as well though, and so if a company is decreasing its number of shares outstanding, your ownership of the company will gradually increase. PYPL has been lowering their number of shares by about 3% this year, so this is a strong tick right there. We can also see that PayPal has been buying their shares back at a low price, which is something I love to see a company do, as they are not wasting their free cash flow on overpriced shares. Next, we want there to be less liabilities to assets. That is a tick indeed. Increasing free cash flow over the last 5 years, that's a tick as well. And finally, we want the price to free cash flow to be lower than 20. For those of you who are wondering, price to free cash flow is calculated by dividing the market capitalization by free cash flow average, and it determines whether a company is over or undervalued. In this case, PYPL gets a tick as well. Well, this valuation now gave us an image of how well the company is being run and how well they are managing their growth and cash flow. PYPL scored a solid 7 out of 8, which is actually a really good rating. Now let's move on to finding the intrinsic value. Let's start by applying the revised grams formula. We take the earnings per share and the 5-year earnings growth estimate of PayPal and plug it into the revised formula. We then divide by the current yield on AAA corporate bonds, which is currently at 4.6. This gives us an intrinsic value of $58, which is 21% lower than the price at which the stock is currently trading at. This is mainly because of PayPal's fairly low earnings per share. Let's move on to our discount cash flow analysis model. Here we calculate the average free cash flow growth rate for the past 10 years, and based on that and our prior 8-pillar analysis, I believe that 15% annual long-term growth rate is a fair prediction. Take in mind that if you want to precisely be able to calculate the future growth rate, you do have to conduct your own research. We then use our growth rate to calculate the present value of our future free cash flows. We take the sum of these values, and by subtracting the total debt and adding any cash and cash equivalents, we get an equity value of $138 billion. We divide this by the shares outstanding and get an intrinsic value of $122, which is quite a bit higher than the present value. We can see that PayPal's total debt and cash equivalents are of the same value, which is a sign of good company management. Let's move down to our multiples valuation model, which is based on comparing the price of a stock to how the market values companies in the same sector and with similar structures. For this analysis, I chose to compare Fortinet, Airbnb, PDD, and Ednerd. We take the current stock price and divide by the EPS and get our price per earnings ratio. We then calculate the average price per EPS, which we multiply by PayPal's earnings per share to get an intrinsic value of $89.5. But what does this mean? Well, if you jump back to our statistics page, we can see that the price to earnings of PYPL is quite a bit lower than the average price to earnings of other companies in the same sector. This indicates that PYPL might indeed be undervalued. We are going to skip our dividend discount model as PYPL does not currently pay out any dividends, and we will arrive to our final analysis where we will average the intrinsic values we calculated to get an ultimate intrinsic value of about $90 per share. But let's say we want to apply a safety net, a margin of safety in other words. If I apply a margin of safety of 15%, we can see that PayPal at this time would indeed be a buy at about $76. So let's jump to my Interactive Brokers account and have a look at the analyst's forecasts. Let's switch to annual, and we can see that earnings per share are foreseen to rise by about 45% in the next 5 years. We can also see that cash flow per share is going to rise by about 45% as well. Capital expenditures are foreseen to rise as well, and revenue should rise as well in a linear manner, as well as net debt, but net debt shouldn't rise as much as revenue, which is a good thing, of course. And now to the big question, should you or should you not buy PayPal stock as it currently is? From what we have discovered, 8 pillars say that the company is being run pretty well. We also found out that the intrinsic value of PayPal is about $90. And as PayPal is currently trading at about $73 to $76, in my opinion, it is a good time to buy. But of course, you must do your own research. I myself added a few PayPal shares to my portfolio about a week ago when the stock was at about $73 a share. Let me know down in the comments if you own PayPal stocks or if you're going to buy them, and see you next time.